Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business developments, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. The constitutional amendment bill for the goods and service tax, which should make India one common market, has been passed in the Rajya Sabha on 3rd August 2016. The government has outlined the GST roadmap with a target date of April 17, 2017. Now, there are two parts to the rollout. The first is to do with the ratification of the amendment bill by 16 states within 30 days, presenting all legislative bills in the winter session, and constitution of a GST council within 60 days of enactment. Further, a GST network and states information technology backend is to be ready by November or in 3 months' time. Let us first focus on the legislative and technical challenges ahead and what the expectations are from different constituencies, including the stock markets. To discuss this, I am joined by Dharmesh Panchal, partner in indirect tax from PwC, Sanket Desai, director Ernst & Young at Ernst & Young, and Ajay Baga, chairman of OPC Asset Solutions. Thank you all for joining me. Ajay, let me begin with you first, and before we come to what is GST and why are we talking or spending so much time on it, what has the reaction been like?
The market had already discounted it to a large extent. So you saw logistics, auto, FMCG, durable companies already at lifetime highs. And we saw a very muted response to the amendment actually getting passed. So most, as always, market front-ended and then there was a sell-off once the event happened.
Right. So you're saying that the fact that all these companies' stocks have hit lifetime highs sort of should lead to the conclusion that it's been good and companies' bottom line should benefit. Is that right?
Definitely. It will be a huge, just a small example. Every FMCG company has to have 29 warehouses at the minimum. And if you do interstate, you have to pay tax every time you transfer your own good interstate. Now, this creates a common market. You can actually have about 10 big warehouses, mega warehouses, which can take care of entire India.
Right.
So I think it's a huge reform, as big as the 1991 reforms.
Okay, right. So let's revisit Dharmesh and try and understand what is GST in the manner that it's being now rolled out, and how is it different from the kind of tax that we experience as consumers or as industry?
So India has an indirect tax system where there are multiple indirect taxes. So when a consumer buys goods, invariably there will be excise duty on manufacture and there will be VAT on sale. The consumer would just see the VAT on the invoice. Okay, so there are two taxes. And when you consume services, there is a service tax. And there is no free flow of credit between what is paid at the center against the state taxes and state against the center. And therefore, it's not an efficient indirect tax system to be competitive, and if India has to go through a double-digit growth rate. Okay, so what we are looking at is a dual GST. So on every transaction of supply of goods or service, there will be a central GST and a state GST. And if there is an interstate supply, then it will be an IGST, which is a sum of both. And you can offset those taxes against the respective output taxes, that is a CGST against a CGST, SGST against SGST, and IGST can be offset against any of the three taxes. So it makes India a common market, and in the long term, we would see that the prices would come down and make Indian business more efficient and competitive, and consumers would get in the long term.
Right. So let's understand that. I mean, why would taxes come down, not go up, or how do we predict today which way taxes could potentially go?
So today, if you look at, if you talk about the major indirect taxes which any manufacturing company would pay, we have excise duty, which is roughly around 12.5% on most of the products. We have VAT, which could be either 5 or 12.5 or 15%, varies from state to state. There are state level entry taxes which are required to be paid, and there are a host of other taxes like the luxury tax. Then there is state level entertainment tax on movie tickets. There are multiple taxes, and if we aggregate all these, the effective tax rate, let's say for a consumer product, it comes to around 28 to 29%.
In any state in India?
Yeah. So the landed cost, I mean, if you take an example of any manufacturing company, let's say FMCG company, which manufactures the product, excise duty plus VAT comes to around 28 to 29% effective, which could go down to 18. So that's the biggest change that we are looking at in terms of the rate. The other important aspect of GST, which is a fundamental shift from the current indirect tax, is that indirect tax today is more of a origin based taxation system, where the origin state or the manufacturing state gets all the tax revenue. Now it will be a destination based tax, which means that the consuming state, where the major population lies or where the final consumer purchases the goods, that is the state which will get the revenues. So that is one fundamental shift as against.
So, Ramesh, is it likely that there could be an imbalance, because obviously some states will be more consuming states than others, which will be more producing states?
Yes, and therefore we had this controversy of this 1% additional tax because the manufacturing states would tend to lose revenue. But at the same time, the manufacturing states would have a large consumption base also, because the manufacturing states are the ones who are more developed.
Right.
So they'll get more revenue from the taxation of services.
Right.
So we would see some imbalances happening. But because there is a guarantee of compensation for 5 years, that should address the concern of revenue loss, and we should see R&R rate which is more reasonable and which gives a boost to business. That's what.
Right. So let's look at the timeline now. April 2017. Most people feel that it's ambitious. What's your sense? I mean, where could we hit the maximum number of roadblocks or glitches?
So I take this question in two parts. One is the readiness from the government side, and second is from the industry side. If we talk about the government side, there are 3-4 major milestones yet to be achieved. The first and most important is to have a consensus on the rates, which is the biggest one. States have to come on board. GST Council will give recommendations on the rates. The second important aspect is the GST network, the IT. As far as the IT is concerned, the government has already appointed Infosys. The GSTN project is on. Phase 1 of that is already over, and they have plans to do the IT backend, be ready by maybe around December, and do the testing by Jan or Feb of the next year. But the more, the bigger concern is on the industry side. Now, if you look at any particular, any manufacturing or any industry, the company for that matter.
I mean, the example Ajay gave, for instance, consumer product companies with 29 warehouses.
Absolutely. Yeah. So supply chain redesign is one aspect which definitely will bring a lot of value creation for companies. But that is not a must-have before the ongoing date. I mean, if I have to be GST compliant, the most and the biggest change that I have to do is the IT redesign, because the crux of GST network or the GST compliances is that it will be IT based. I mean, I will have to upload, any company will have to upload all the sales data in a particular format on the GST network. So the IT redesign is the biggest and most critical one, which companies will take time to work on.
Right. So Ajay, what's your sense? Where do you feel the hurdles could be? And you were talking about market in a sense already having priced in. So to what extent is that, and what does that reflect?
Yeah, see, hurdles are going to be practical, as he was also mentioning. You look at when VAT was introduced, and it's taken us about 11 years. Even today, you make a sale here and you look at the contra entry, you will keep on getting notices from the tax guys that there's no matching entry found. This is after 11 years. So it's not going to be that easy.
That doesn't sound very encouraging. But
and
anyway,
you look at Infosys, they were given the ROC contract. It has become horrible, the ROC site. You try to increase your capital, you try to just do any upload, it takes you 3 to 4 weeks. So doing this testing with 41 million SMEs trying to file in their GSTs and all, I don't think it's going to work in the short term. It's going to be horrible for the next 2 years in a practical sense. Good thing is we have been preparing for this. So EY, PwC, all our good friends have been advising us, and as we have been trying to see, all the big companies have put in the backbones. But I think it will fail at the government end, and I have very little confidence on Infosys being able to deliver, seeing what has happened on the ROC side.
Okay, so hopefully the right lessons would be learned, and the complexity, now that it's much bigger, will hopefully also involve or invite much more effort. So let me get the other point in. So we talked about the formal sector. So there's also the informal sector which does not pay tax, right? And that also employs almost 92% of labor. Is that likely to be hurt, considering that margins will shrink dramatically if you start paying taxes?
I think there would be a temporary impact, but not a significant impact in terms of any job losses or something. The unorganized sector would take time to bridge that gap, because the competitiveness would lose because they have to start paying taxes. And also, it's gradually the unorganized sector would come into the GST network. It's not that from day one. So that's the timeline, and that's the reason why why they are saying is we are not comfortable with 18% R&R rate, because it's not that the tax base is going to increase significantly from day one. It's going to take time. So it's not going to be an abrupt impact, there will be a transition and the economy would settle down on that.
Right. Ajay?
It's a very good point because if you look at FMCG, organized FMCG is 10%, 90% unorganized. Plywood, 90%. There are most of the industries are 40 to 60%. Market is discounting and giving valuations that you will have a level playing field. People who are never paying tax are not going to start paying tax from tomorrow. The whole chains are there which never pay tax. So I think that's a brilliant point he's brought out. Market is overvalued in that sense. They are saying that, okay, all these companies, logistics is a direct beneficiary. Your trucks will become more productive, all the octroi goes, all the time you were wasting. FMCG, big beneficiary. But in terms of market share and level playing field, that's a 3-4 year process. But market has run up ahead of itself.
Okay. So let me just touch upon very quickly the preparedness of industry itself. I mean, we've already hit it. So formal sector is better prepared. I think you were quoting an interesting example. You were saying that you did a report for a company in 2009 in terms of GST anticipation, because that's when we started talking about it formally. So that's, but in the meantime, obviously the market has grown. Maybe it's become more complex, and maybe the nature of the engagement with consumer has changed too.
So as far as the industry preparedness is concerned, FMCG sector has been the first mover. I mean, this whole discussion on implementing GST, the earlier date being target date being 1st April 2016, the journey for them has started in 2015. Feb or March of 2015, when the big ones, the big FMCG companies started thinking about having a proper plan, implementation plan, starting with doing an impact analysis, what will be the impact on their P&L, what will be the working capital impact, what are the changes required in their supply chain, as Ajay was mentioning, reducing or consolidating your warehouses for better efficiencies. So the market, the industry preparedness as far as the organized sector is concerned, is very much there. Lot of companies, lot of big companies have already done the phase 1, which is the impact analysis, preparing a kind of a blueprint, and they are waiting for the final GST law to proceed on that implementation.
Right, and the rate, which we'll talk about in a second, right? I mean that's something that has to be factored in before you build your systems.
Yeah.
See, the biggest impact would be for the services sector, because they're used to paying tax centrally, and most service sector, like you say, banks and logistics companies
or media companies, us,
especially which are B2C, they would have invoicing systems and develop different ERP systems. For them to do a GST migration from a IT, from an information technology perspective, it would take minimum 6 to 9 months. That's a minimum time, because a bank would have several IT systems operating. So it's a big transformation there. So what businesses are looking at, business continuity. When GST comes in 1st April 2017, my supply should be on, my services should be on, my invoices should be generated, and that's the first priority which they are looking at. So I do see a challenge in terms of being ready by 1st April 2017. Even in the organized sector, some players may not be on the right version of ERP, and they need to move to that version of ERP, and then they can put in a GST patch. So there could be a case for a 3 months extension to be looked at.
Yeah. Right. So last question, Ajay. So what's your sense of the rate? I mean, what's a good rate, if any? I mean, there seems to be speculation on both sides. At what point could it hurt consumers? At what time could it benefit the government?
It hurts the service sector. It is good for the manufacturing. That's the simple answer. It will be more than 20%. It won't be, RNR might be 18, but the standardized rate will be more than 20. Because today they were paying 27, 29%. So if you have to stay revenue neutral, you will have to keep that. So I think short term, Indonesia example, you look at other examples, it's inflationary. The estimates are anything from 0.2 to 0.7% of inflation comes in. Rates will be higher than 20%.
Right.
It will hit services more.
Right. So absolutely last question, Ajay. So this was one big reform step that everyone, including the markets, had been waiting for. I'm not saying it's out of the way as yet, but work has begun on ground. So what's next?
No, this is very big because tax on tax goes, the cascading tax goes, especially exporters become much more competitive. Now next structural reforms, there are a lot of reforms, be it disinvestment, be it just the ease of doing business. I hope they take every part of that entire process in mind. So I think a lot of structural reforms, and main thing is when you get into the winning habit, government has got a formula of being able to navigate this.
Right.
So now they've figured out that unpopular or unpleasant decisions, how they can be done. I think it's very positive, especially foreign investors are looking at it as a huge positive for the Indian economy.
Right, and that's a good note to end on. Thank you so much. We need to go in for a break. Coming up on the other side, we speak to industry representatives and find out how they are gearing up for GST. Stay with us. Welcome back to Policy Watch. Creating a One India, One Tax regime as the goods and services tax regime also requires industry to be adequately prepared to reorient itself. Now, much of industry's response also depends on the rate structure and the ability of states to engage uniformly. Now, the question we are asking is industry ready to transition to this new regime? What are the steps that industry has to take, both as manufacturing and services? What could be the concerns and pitfalls, particularly for small and medium enterprises? And finally, what is the economic impact of a single tax going to be to buyers of the final products and services like you and me? To discuss this, I'm joined by Sunil Khanna, President and Managing Director of Emerson Network and Chairman of the Confederation of Indian Industry Maharashtra, Premal Udani, Managing Director of KT Corporation and past Chairman of the Apparel Export Promotion Council, and Dipankar Mitra, economist. Thank you all for joining me. Let me begin with you, Premal. What's your sense as a garment and textile manufacturer? Is this something that's going to be good news, and if so, how and when?
I think for a country as a whole, this is very good news. It unifies the country by way of taxation, and we welcome it. I think every industry has welcomed it. We welcome it too. The only concern is that currently textiles and apparel are perhaps in the lowest possible slab of tax. And it is rumored that now the tax, currently it's about 6 to 7%. And we want to see where we land up at eventually.
Right.
Because roti, kapra, makan, this is a basic need.
Right.
So we hope that the tax burden would be as minimal as possible.
Right. So the rate is something that we're all watching out for, including which industries will be benefited. Sunil, can I come to you? What are the timelines that you see playing out when it comes to, the way it's been projected and the targets and deadlines that have been set by the government?
First of all, CII welcomes the passing of the Constitution Amendment Bill 122 by Rajya Sabha. This is a landmark achievement in the history of India. Now, the bill has been passed by Rajya Sabha, but it has to be approved by 15 states. The GST Council has to work on the tax structure, and this is going to take some time. While the target date is 1st of April, we feel that, though it's not impossible, we feel that next year in 2017, it should be possible to implement the GST. Now, GST requires a lot of, foundation, IT foundation to be laid. The government, not only the government, the companies, they have to be prepared. How do they roll out the GST? How they implement the modify their ERP system in line with the GST. So that's going to be a big challenge for all the industry.
Can you tell us about industry preparedness, Sunil, and maybe you could use the example of your own industry in the automation space?
Well, this bill, we have been talking about this bill for last 10 years. When Kilkar committee was set up, they came out with a recommendation in 2010. And at least for the last 5 years, industry has been eagerly waiting for the GST bill that removes complexity, creates transparency, the cascading effects of the taxes with replacing with one single tax structure. It's a welcome move by the government. We were looking forward to it. Now, as far as the readiness of the industry is concerned, yes, we have done some work, but there is a lot to be done, and this will be based on how the GST Council comes out with a tax structure, what all segments are included in the GST bill, which items are not, how they are going to lay the structure of the bill. But yes, the industry is getting prepared. There have been a lot of interaction within the industry, within CII on GST issues, challenges. We have been working on it, and CII, at least during the last 2 months, they have worked very aggressively, organizing various conferences to make especially the small scale industry aware of issues, challenges with the GST.
So, Premal, let me bring you back in. So, if you were to look at the operational rollout, so as Sunil said, there is various stages of preparedness. Do you see the preparedness on the industry side being as much perhaps? The government seems to be very clear about its targets. Now, whether they'll achieve it or not is a different issue, but do you see industry keeping pace?
No. Very simply, there are no details available. We have no clue how it's going to operate. And sometimes,
Give me an example when you say that.
For example, we have a very robust export industry of apparel. We are $15-17 billion industry. Now, how are our taxes going to be rebated? Because obviously, when the state taxes and other taxes go, then how will we get rebate when we export the final garment? We have no clue as to how that is going to work.
Okay.
So we request that the government engage with the industry, assuage all our concerns, and eventually come up with a scheme which is easily enforceable, transparent, and something that we all can live with, especially the small and medium scale, where they don't have the wherewithal or huge budgets to be able to find people to do all the work.
Right. So the other concern, and I put this earlier as well, is the small and medium industry which does not pay tax, and I'm talking about unorganized mostly, does not pay tax, can get hit quite badly. Is that right?
We believe everybody should pay tax. I think in a democracy,
the basis of existence is not paying tax in many ways. I mean, for some unorganized sector, yeah.
Yeah, but I believe that increasingly the government is doing the right thing, getting everybody keep low taxes so that you ensure more compliance. And that's our concern, that if the taxes are low, you will have more compliance. If the taxes are very high, again, you will have the unorganized economy flourishing from the other side.
Right. So, again, to come back and ask a fundamental question. So, is GST going to resolve all of this and help us move towards a more efficient, stable regime?
We hope so, because in the domestic markets, every manufacturer sells his product virtually in every state. Now, movement of goods from state to state has been a huge issue, a huge bottleneck. So, we definitely hope, and we are sure that it will take care of all that. But how it will operate, we have no clue as yet.
Right, but at least, conceptually, we could have a Europe-like situation where goods should be able to move, or lorries and trucks should be able to move without hindrance.
Seamlessly, absolutely.
Right.
Absolutely.
Okay. So I'm going to come back to Sunil in a sense, but Deepankar, let me a couple of questions which is again top of mind for most people. One is, the primary one is inflation. Is all of this, because prices are going to rise because of a higher rate, is it going to lead to inflationary conditions? CRISIL is saying 60 basis points rise is most likely.
No, I think as has been clarified by the Arvind Subramaniam committee report, that the larger part of CPI basket as such is excluded from the tax net in any case. So that doesn't get affected. Roughly 30% or a little more than that is taxed at a lower rate, and only 10 to 15% is taxed at a standard rate. So if we take that, the headline CPI measure would not be impacted that much. Now there is a concern that if the service tax is raised from the current level to the proposed level 18% or 22% or whatever it is, then there will be an upward thrust to the services inflation. That may be the case, but what we would have to distinguish whenever we talk of GST impact on either at the aggregate level or at the sectoral level, we have to differentiate what is in the design of it and what is consequential. So in the design of it, it is not inflationary. If the overall tax collection is actually meant to be revenue neutral, then obviously at the aggregate level it is not inflationary. But then yes, the different sectors would be impacted differently as a consequence of this change, and therefore there could be some sectoral level inflation.
Right. Okay. As we've heard. Yeah.
One more point. If we sort of compare the international experience also, there is no uniform impact of this implementation of GST on inflation. Certain countries it has gone up a bit, in some other countries it has gone down.
So I was reading a State Bank of India report. They say that the experience in some countries at least seems to be Australia, Canada, New Zealand, Singapore, they've looked at and said it seems to go down over a period of time. And Australia being the most recent or one of the more recent entrants into the GST regime.
And Canada being one of the most interesting ones.
Right, okay. So let me get back to Sunil. So there are two kinds of efforts. I mean, this is more of a timeline question. There's the internal part which industry has to do, and there's the external part which is including dealing with government. How do you see this panning out?
Yes, this requires a backbone IT infrastructure to be laid out, while companies like us are prepared, and our feeling is we are going to start working on, we have been working on it, and it may take about 4 to 5 months for us to fully test it. But yes, the challenge will be with the smaller industries who are right now working, who do not have a very solid IT backbone. They have to invest in IT infrastructure, on resources to train people, because this platform provides, a portal wherein you get the credit, the debit, the buying, selling, the tax credit, and unless there is a total alignment in the portal, you will not be able to take credit for the various taxes. So this requires a very thorough implementation, ensure that it is defect free, virtually 0 ppm. Else, you get into the rebate, the taxation notice issues.
Prema, let's build on textiles and garments. I mean, you had an industry package just recently, and I mean that was seen as landmark in terms of the money that has been put aside, some of the tax benefits that you've got. Now, the combination of GST, is this overall an industry reforming step for you? And to that extent, what does it tell you about the reform measures that we're taking, the opening up of the economy from an industry point of view?
First of all, the garment and textile package announced was really path-breaking. It's been a recognition of the industry that is the largest job creator in the country. Successive governments have not done it. This government has done it, and they deserve full compliments for the same. The idea is that this is an industry that can create millions and millions of jobs without too much of educational requirements. It's job for real India. Also, it will help in creating more demand for clothing in the country. Our per capita consumption of clothing still continues to remain at the lower end when you take the world as a whole. Now, when you put that against taxation, there's always the tussle, because too much tax can again act as a dampener. So just when the Prime Minister has announced a package to put full accelerator on, we hope that finally whatever tax comes out, it doesn't become a dampener for the industry. But overall, GST is the future. You can't have this multiple plethora of taxes that we suffer from. It'll reduce corruption to a large extent. It'll reduce ad hoc bureaucracy to a large extent. And if the rates are kept reasonably stable, I think it's a win-win situation.
Right. So last word, Dipankar, what's the ideal rate which will keep everyone happy?
I think the two expert committees of the government have put the rates as wide as 18% to 27%. Now, I guess the eventual rate will be closer to 18, not 27%. But there is a point here is that there is a whole lot of uncertainty about the revenue collection that would eventually happen at the state's end. And when we talk of the RNR, we have to keep in mind one question, is that are we talking of an RNR at the overall aggregate level, which is center plus all the states together, or are we talking of an RNR of the state which has one of the least revenue potential? So if that anxiety is built into the state's decision making about the GST itself, then there will be an upward bias to that rate to that extent. And also the entire period of 10 years of discussion and negotiations was actually loaded in favor of the center states collections and that concern. So I guess the overall revenue will have an upside, potential upside coming from various sources, and primarily because of the exemption list would be pruned quite a lot. Secondly, the rates will eventually possibly settle down with an upward bias. And also because the government, all the state governments has to have a path where they see after 5 years their revenue has completely stabilized when the compensation period from the center ends.
So we've run out of time completely. Thank you so much both, and thank you Sunil as well. We've run out of time, as I said. We'll be back next week, same time. Thanks for watching.